Welcome back to Switzer and Australia's Business Channel. When the index struggles to break a certain level, sometimes it can be for technical reasons. So let's go to our technical expert, Gary Stone of Share Wealth Systems, to see if there's a good reason why we can't smash that cursed 6,000 level. Gary, thanks for joining us.
Yeah, it's a pleasure, Peter.
So rather than getting on with any sort of niceness or whatever, let's go straight to your first chart. I asked you to look at the ASX 200, and what are you seeing there?
Well, Peter, 6,000 is a big round number, and big round numbers have to be taken note of in the stock market. And I have no doubt that it will cause some resistance, but excuse me, I don't think that it's going to be a major issue for us to get through that. I think the trend is definitely intact here, and it's going to go higher. The environment is such of low interest rates and relatively low GDP growth is that we are going to go higher. And I think where we're going to track to, if you look at the chart that's on the screen there now, the middle two trend lines are going to cause a bit of resistance, but in an upward rising slant. But where we're headed is, in my view, to get back into that upper channel, the very top
green line,
slanting, no, the upward slanting black line at the very top there. So that's where we're headed, and that's going to take us to round about the previous all-time high, that 6-7 level. But we're not going to go there in a straight line. It's probably going to take most of this year and maybe even to next year before we get there, and it's going to be up and down along the way, but that's where I believe we're headed.
I think the all-time high, Gary, was 6,828, wasn't it?
Thereabouts, and that's the very top red horizontal line that you see along the top of the chart. Yeah.
Okay, all right. So is there anything that you like? Like what we see there is the market's going up virtually inside that channel. What does it take to break out of that channel?
Effectively, it takes confidence, and confidence comes from, there's a whole bunch of variables that come into it, and which one gets the upper hand and the most weighting at any given time, we won't know in real time. We'll be able to look back in hindsight and pick on which one it was. Yeah. But if you look at our market, we've effectively had the last 4 or 5 months, or probably only 3 or 4 months, where we hit the bottom of the black, the very lower trend, a black trend line that's rising, and we've jumped from there, which is only about 3.5 months. And the March 2009 to January 2010 is the only part of a bull market we've had that everybody is talking about us having been in a raging bull market, which in my view is a lot of BS. We've only really had about a year and a half of 6 years in bull market. The rest of the time we've been going sideways. So we're very unlike the DAX, which I know we'll look at next, or the US markets. We are not in a raging bull market. We are far from it in this country, but hopefully we will become a raging bull market for the next few months and into next year.
Okay, well, let's go to the DAX. So I asked you to do that because they're in all-time highs. They're obviously the best economy in Europe. Europe is expected to benefit from the QE program. And so what does this chart tell you, Gary?
Well, the DAX to me is the NASDAQ of Europe. It's very volatile. What it tells me, we've spoken for quite a few years now, it's probably about 2.5 years, about secular bull markets and secular bear markets. And the DAX was the first and only European market to break out of the secular bear market, and that's where it went above that blue rectangle that you see going through the middle of the chart there. And its timing was almost exactly within a few days of the S&P and Dow doing exactly the same thing. And it's those horizontal lines going across there are what we call Fibonacci projection lines. It's gone exactly to the textbook where it's found resistance. It's remained in a secular bull market, just like the North American markets, the small cap index, the mid cap index, the S&P 500, S&P 1500, the S&P 500, the Dow Jones, the whole lot, except the NASDAQ, are in secular bull market territory, and the DAX is well and truly in that territory, driven by all like stuck records, low interest rates, and interest rates that are obviously not going to be rising, if they do, not sharply anyway in the near future. And by a QE program that's happening in Europe and the UK and as in Japan as well, which started before Europe.
Yep.
So we have cheap money, and that's certainly going to push along equities, but it's also, as you were talking with Martin, it's a leading indicator. Stock markets are leading indicators of better times to come in the economy, where we're going to hopefully get some GDP growth as well.
Gary, over the weekend, for the Switzer Super Report, I did some analysis on unusually long bull markets. And the three that stood out was the Great Depression one. There was a really long bull market, and the market went up by a lot. Then the World War II bull market once again, and the bull market around Reaganomics. Three really long ones where, we're talking over 90 months or even longer. But also the rise was like 900, 800%. And I think our market, well, the S&P 500 is only up about 400% at this point in time. Do you feel as though, because of this unusual circumstances of historically low interest rates, that we probably will go for a long bull market?
Absolutely, Peter. And I've put that chart up and we've discussed it before. Over the last 116, 17 years on the Dow Jones, there have been 4 secular bear markets, which have been followed by secular bull markets. And I know you measured it. I read your report on the weekend. You measured it in terms of time, in terms of months. But in terms of percentage terms, 2 of those secular bull markets, and I'm not talking about from the bottom of the rise, I'm talking about from when they broke above their previous high, went 600, 800, and even 1,200%. So the S&P 500 went 1,200% from October 82 through to December 8, 1999, January 2000. And that was an 18-year secular bull market that rose 1,200%.
Yeah.
So I know there's been a lot of talk around recently about it's 6 years now, and we're up 180% from the dip in March 2009. And it's been so many months and 6 years, and they've gone back and measured 6-year cycles prior to that. Well, that's just all retrofitting because we just happen to be 6 years, and it's an anniversary of when we had the dip, the bottom of the dip in 2009. So that's just retrofitting, BS again, sorry to use that term, but there's a lot of rubbish that gets put out there. Yeah. But effectively, this secular bull market started in April of 2013, and we're not even 2 years into it yet. And we're certainly not anywhere near 1,200 or 600, 800% above that breakout. So we've got some time to go here, not in a straight line. All market PE ratios are relatively low. Interest rates are low. But, we're going to have dips, there's no doubt about it. But we're not heading for a crash or anything like that at this stage.
OK, let's go to BHP. A lot of people are worried about what they're seeing. But what are the charts telling you, Gary?
BHP is still too early, Peter. It's bouncing along the bottom level zone or resistance zone. When the chart comes up, it'll be quite evident.
There it is.
So, what I'm looking for BHP to do is that the first sign will be breaking above that middle resistance zone. So it's almost like a median support resistance zone. And that'll be the first sign. But really, I wouldn't be getting into BHP until it gets above the top resistance zone in red, that horizontal zone there, which is above $40. I know it's down at 31. And at this stage, technically, this chart is still bearish. It's not even it's not even any evidence at this stage that we should be getting in early and trying to get the up run. That's not to say that it won't take off from here. But if you look at the commodity indices, which we have looked at before, both here and on your super report, they're still heading down. They're all in downtrends. And sure, the cycle may be overspent. But there's no evidence that we should be getting in at this stage. So I'd be staying away from both BHP and Rio.
OK, let's go to Woolworths now. Another one that people are worried about, and the price has gone down. It looks like, is that, OK, there it is. Fairly similar in the sense it's gone up and then gone down again.
Yeah, well, it's bearish. This is not a positive-looking chart at all. It's stuck in a wide-ranging sideways market here. It had a breakout. In fact, when it broke out, you can see right at the top right-hand corner, it had a breakout there. It was a false breakout. All that turned out to be was an expanding of the range, which does catch technical analysts out at times. I remember at the time, on the Switzer Super Report, I did say, here's a breakout. They'd put a stop, pretty close stop just below it. Yeah. The breakout was false and has fallen down. It's now had a 50% retracement back into that range trading sideways movement. And it should find some resistance here, but if it falls below the prices that it's at the moment, look for it to go all the way to the bottom of the range. So it's not good at this stage. It'll be a bottom pick and it'll be a guess to be getting into Woolworths at this stage. And sorry, the other thing that's not shown on there, because that's a line chart, is the big gap down that it had. So it dropped about $3 or $4, if I remember correctly, from the announcement that came out. And that gap's going to have to get filled on the way up before there'd be any confidence in getting into Woolworths at this stage.
All right, mate. Thanks for those observations, and we'll talk to you in the not too distant future.
It's a pleasure, Peter.
See you, mate. Coming up next, we have the CEO of All Media at a time when I keep getting positive vibes on outdoor media.